Hello everyone, in this video, we'll continue to discuss the cost flow of job order costing in Chapter 3, and especially we'll learn how to prepare the two cost reports based upon the cost flow through different accounts in the balance sheet and income statement. I have this information in the next worksheet of the Excel file I posted in Blackboard. This information corresponds to the discussion on the book on page 60 of the ebook. We majorly have two cost reports provided by the managerial accountants. One is the cost of goods manufactured. Other names can be cost of goods produced or cost of goods completed. So by the name, we can tell this report tells the managers or the users the information about the cost of the jobs or the products which the company completed during the reporting period for this month, this quarter, or this year. So rather than provide a total, like a simple cost number, we give a layered reports. So we have different items organized in these reports, tells the users how we end up with this cost of goods manufactured. If you check different textbooks or like the practical worksheets, the formats may be slightly different or a different version of the book, but basically we are following the same logic with minor differences. In our book, we used this structure. This is a very nice format. It helps us understand and track all of the cost information. So first, you need to list the beginning work in process inventory by all of the job or products. And we can get this information from your working in process account, the ledger account we have from the prior worksheet. Beginning working in process inventory. For our question, we only have beginning working in process for job A, which we started early. For job B, we started in this period, so no beginning working in process for job B. And then we'll add the three manufacture costs incurred for this period. So direct material used, direct labor, and applied manufacture overhead. So beginning WIP, add the three new manufacture costs. But to get the direct material used, as we learn from the ledger account, the material goes through the raw material account. So to give more information, we have a mini schedule for the direct material used. So for direct material, we have the material beginning balance, which listed under the raw material account. Beginning raw material, add the new purchased materials. Then we have the total material available to be used. Okay, so for direct purpose or indirect purpose. Then minus the ending raw material. So all of this in this parentheses. Okay, so you can check so all of the grid, like the rows, you can see the information from the raw material account in the cost flow charts. So raw material beginning balance, new purchased, add the new purchased, minus the ending raw materials, so we can get the used material. So after this mini schedule, we can get the direct material used for production is 50,000. Direct labor, we can find it in the working process directly. Then be careful, apply the overhead 90,000. Do not use the actual overhead, apply the overhead. So adding all of the new three manufacture costs, we call total current manufacture cost 200,000. So this 200,000 added to the beginning WIP, you got the total manufacture cost to account for So account for means this total amount will be split into the cost of goods manufactured and the ending unfinished products. By the end of the period, we learned the job B is still in the working process by 72,000. And this information, again, you need to check from your ledger accounts. And then the finished goods all belongs to job A. The job A is completed with the total amount of 158,000. So we have a split for unfinished goods and completed units by the end. And then the 158,000 will be the final cost of goods manufactured reported in this reporting period. Okay, for our example. But as we can see, if you have multiple jobs in real companies, you may have like 30 or 40 different jobs, and you need to really check details. And gladly, with all of the computer and the system, the preparation of the cost reports become very easy, and accuracy is improved a lot. Think about you used to have all of the manual system, right? So we manually differentiate and trace all of the cost is a tremendous amount of the job, and the requirements for accuracy is very demanding. Then the next cost report is reflecting the cost for the goods completed and sold, okay, which is the cost of goods sold account we disclose in the income statement. For this cost reports, we prepare based upon the finished goods account, which is related to the finished goods account, which is here. In our example, we have a zero beginning finished goods balance. In reality, so I'm putting a zero, it's not showing the zero, is like not applied. In real companies, if you have unsold products from prior periods, you may have some numbers as the beginning balance. And then we add the current cost of goods manufactured, then minus the ending unsold. So ending unsold units, we can find out the cost of goods sold. So the cost of goods report is a reporting format to reflect the cost flow under the finished goods account. Because for general users or managers, they wouldn't have time to log into our accounting system, or they couldn't really understand the debit-credit structure of ledger accounts. They need something in reported format, tell them, okay, the cost of goods completed and cost of goods sold. So that's the purpose. Periodically and in routine, we generate these two cost reports. So now let's look for the cost of goods sold in the reporting format. We have the first item is a beginning finished goods. We have zero in this case. And add the cost of goods manufactured, okay, which flow. These two numbers must match. Oh, I'm sorry, it should be here. Since we have beginning zero, so the total finished goods available for sale equal to the current cost of goods completed. If you have beginning finished goods, the total available will be different. Then minus the unsold, okay, unsold finished goods. You may wonder how I can know the unfinished cost. That's related to the inventory valuation we talk about in accounting 231. So you can use the FIFO. Remember LIFO, last in first out, first in first out. So all the weighted average. Yeah, that's linked to the inventory valuation. So you use the different valuation method, get the ending unfinished goods, and then use the total available for sale minus the unsold. So we got the unadjusted cost of goods sold. And you remember the unadjusted because we haven't applied or cleared the under-applied or over-applied manufacturer overhead balance. In our case, we have a under-applied, so it will be a plus. For under-applied overhead, we add, and if it's over-applied, minus, we add a deduction to the cost of goods sold. So we have the final cost of goods sold, 123,500. So these two cost reports, we only prepare and offer to internal managers or internal users, because these represent detailed or private information of the company is not available to external users. External users, we put the traditional absorption income statement, which we talk about already here, if you recall. So external users, we offer the income statement. Here we have a brief information about the manufacturer cost and non-manufacturer cost, but as external users, they have no idea how we end up, right? So how we got this cost of goods sold, the distribution of the material, labor, and overhead. Even for sales revenue, they have no idea about the sold units and the price. They only have the total information for general understanding about the company's operations. So these are for external users. And these are for the internal managers and the internal users. So by finishing the cost reports, and basically we finished the most of the topics for job order costing system. In chapter 5, we discussed the process costing. We pretty much follow the cost flow as job order costing. The main difference for process costing is when you organize the productions or your cost system, we organize the working in process by departments or processes rather than by the jobs. Because process costing, they apply to companies, they produce identical or very similar items periodically. They are not making the products to the customer orders, such as the food and beverage, textiles, electronics, right? They don't have a special customer. They just produce on recurring, continuous basis and waiting for the customer to buy from them. So I will finish so far, and the next topic will take a look for the main cost accounting issues in the process costing system.